I am so honored and blessed to have my friend Dante Shackleford of Finance and Growth. Now, you're probably saying to yourself, Jimmy, what's Finance and Growth and who's Dante Shackleford? Well, first off, let me say this. Dante is an amazing dude who has a ton of experience, especially for all of us people in the real estate industry, especially on the investor side. Dante is going to share with us exactly what it is that he does and what he specializes in. And more importantly, he's going to give us some tools to consider as we head into a changing and very interesting market nowadays, going forward for the next few years, I'm assuming, because we're going to have a lot of different strategies. The strategies that we use during the boom are not the strategies that we're going to be able to take advantage of going forward, at least for the next few years. And Dante is going to share with us some of the things that we need to consider with that. So whether you're a newbie or experienced investor, this video has got something for you. Dante, it's all yours, man.
Hey man, Jimmy, you're too kind. I appreciate the beautiful introduction, man. Really appreciate it. I'm honored to be here. And hey, right now is a great time to have some serious discussions about investment real estate. I think I was told this years ago, and it's rang true. I've been in the business in some form or fashion since 2003, which means I've gone through bubbles and recessions and credit crisis. And in that time, you learn that, anyone can get in and do quote unquote well when the market is advantageous.
Yep.
But real professional investors, those are the ones who, in some cases, they'll wait for a time like this. In some cases, depending on their strategy. Because this is usually where we can even use other, industries, not even necessarily, well, not industries, but professions in the industry of real estate. You look at who's going to sell the most homes and list the most homes. It's going to be that agent, the real estate broker, who is professional. They really understand their craft. They study it. They've put the work in. They've put the work in during the good times so that in the bad times, hey, the fakes, they flee.
Yep.
And so I think it's just perfect timing for people who maybe they haven't experienced any turbulence yet. This is your opportunity. This is where you really earn your stripes in a period like this. So I'm excited to talk about it.
That's awesome. That's awesome. That's one of the things that I found. I remember being a little kid and I heard this phrase that, millionaires and billionaires, they make their money not in the up times, but in times that I think we're heading into, which is the recessionary times. When everybody is selling and running for the hills, those are the ones who are usually swooping in, picking up properties in our case, or picking up assets and waiting, and waiting for the wave to change. Yep. Now, it takes a lot of skills to do that. It takes a lot of mental fortitude to do that. And let's be honest, not everybody has that. That's what I found to be the differentiator between people who come out of this sucker way above, way down the road, and those who just eat through. So today we're going to get some information to make sure that we're further down the line and not the ones that are just eking through, and that the upcoming, I'm not going to call it a recession, but the upcoming market shift is going to spit out. We want to be one of the ones that actually thrive.
It's okay if you say the R word.
Oh, you better not say that. You'll go to hell.
I can say the R word.
It's bound to happen. You can say the R word. Yeah. We'll touch on that a little bit today. The R word it's not a bad thing. It's That's expected market conditions. We have cycles, and it's good. It's actually good in the long run.
So you mentioned it. What real estate cycles? What are you talking? Or it's just not real estate. It's economic cycles, right?
Economic cycle, right? So real estate has its own cycle that mimics in many ways. If we're looking at capital markets cycles, or you can look at economic cycles based on growth and CPI and that sort of thing. They all kind of track each other. The most general cycle is the business cycle. So that's just economics 101. You have recessions at the bottom, and you have peaks, and then you have expansion, and so over time, the market does tend to grow, but it doesn't grow straight.
True. It is very sinusoidal. It's like a way up. Goes up and down, up and down.
Yep.
Okay. So right now, since we mentioned it, what do you think we are right now?
I think we've reached the peak a little while ago, and we're on our way down. We're not at the bottom. That's the simplest way I could explain it. With each market cycle, you may have situations that are unique, and look at it from an organic standpoint, we may be in a different place. What caused it to not follow its organic route where everyone would feel really comfortable about what's happening next is COVID. And we're dealing with that in terms of inflationary pressures right now because, well, a lot of money was printed. And they understood at the time that free money, is just supply and demand, right? You have too much money in the market, then prices are going to go up.
Yeah.
And so I think that was unique. And most people at this point, if you're in the real estate and finance, I'm not going to go on and on and on about, COVID's effect on, where we're at right now in terms of inflation. It's here. And the Fed is dealing with it. Fed Chairman Powell, he just did a 50 basis points increase yesterday at the Fed meeting, which is a little bit lower than 75 basis points, which is indicating that inflation is slowing. But we still got some ways to go. Fortunately for us, real estate has always been regarded as a really good inflation hedge.
Okay. So just to make sure I understand, when you say inflation hedge, what do you mean?
Well, generally rents, think about it this way. So in times of inflation, your interest rates are going to rise.
Yeah.
Right? Because you're trying to limit the money supply. Okay. This is what the Fed is doing via monetary policy. So you do have higher rates, you do have higher interest rates, but oftentimes you may have rent growth that offsets that. So rent growth just slowed down, I think this month for the first time in a while. It's still at 5.9 for multifamily. So rent growth does offset some of the increases in interest rates, and we'll just call it inflation.
Okay.
So with a real estate asset, not only do you have income, but you also have capital appreciation over time. And so those things tend to benefit investors as well.
Okay. So basically what you're saying is if you purchased property last year you purchased a property and your outgo was at a certain level. And due to insanely low interest rates a year ago, one of your biggest expenses would be your mortgage interest payments, which were excessively low. Based on historically speaking, all of your other stuff is probably about the same, right? Water, your electric, and all that other stuff. And if you're paying those things, they're all about the same. That was last year. So now you have this property that you got a tenant in, and also you had a tenant that was paying a very nice amount of historically high amount of rent, maybe in some markets. I know here in the Detroit area, landlords have been making a killing.
Yeah.
I mean, they just have. Because the average rental for a 2-bedroom property or a 3-bedroom property in and around the city of Detroit is really, really high.
Like you said, that was last year.
That was last year.
Right. So
this year, you still own the property.
Yeah.
Hopefully you're in a situation where, you didn't do something silly, tie your mortgage payment to the interest rates. So you're still paying a little bit of interest. But one of the other things, you saw your property increasing in value significantly over a very short period of time. Well, now that part might have stabilized a bit. So if the property at the end of the year was probably worth, say, for our sake, 200 grand, plus or minus a few percentages, but it's probably still about 200 grand. 2 years previous to that, it may have been worth 240 based on the appreciation that people were seeing. So now you're not experiencing the same price increase from your capital, but your rental rate is still way up there. Your costs are still low.
Yep.
So that was last year.
Try to shed some light on why in a real simple way. So when rates are at a historic low, as they have been, more people can afford a home.
Yeah.
They can afford to purchase a home. Okay. Yeah. So let's say that pool of home buyers in this local city is 100,000. 100,000 households can purchase a single family home. Rates are at 4. During that time, hey, as an investor, now let's switch to the other side. As an investor, you have a 4 unit and you're competing with potential homeowners.
Yep.
Okay. So your rent is 1,000. But at 4%, their mortgage payment will be $950. They're considering what? I mean, I know I don't have the down payment if I rent $4,000, but with FHA 3.5%, I think we could save that in a couple months, save our monthly housing expense, rent versus mortgage.
Yep.
We'll just go buy a house.
Yep.
Now, take same exact scenario.
Sure.
Mortgage interest rates are no longer at 4. Let's say mortgage rates go up to 8. Remember the 100,000 households that were potential home buyers?
Yeah.
All of them no longer qualify.
Yeah.
Okay. Now only 70,000 qualify to even purchase a home.
Mm-hmm.
And now, even of the ones who qualify, they may do the math and they may say, well, 8% takes, was 1,000 or what I say, 950
Mm-hmm.
would have been the mortgage payment at 4%. And let's just say hypothetically, well, at 8%, that payment isn't 950. That payment is, $1,200.
Yep.
So since that payment is now $1,200, well, the investor who was competing, right? He was competing with the potential, competing with sellers, let's say.
Yes.
Home sellers to these pool of buyers. He could bump his rent up to $1,100 and still be a better option.
It'd be very attractive.
That's kind of a off-the-cuff case study of, in a simple way, why in some markets you'll see the demand switch from, hey, let's go buy a home because it makes economic sense, to, I think I'm gonna hold off. Let's rent for a little bit longer until the market cools down.
Mm-hmm.
So that's typically, I'm giving a general case, but that's typically why real estate has been seen as a good inflation hedge.
Makes sense. Makes a lot of sense. See, and that's the cool thing about real estate, right? When you're owning real estate, especially as an investor, you win in either scenario.
Yeah. When I was a financial advisor with Merrill Lynch, we always will refer to, and a lot of other people refer to it this way as well, but sometimes it's better to invest in dirt, meaning something physical.
Yeah.
Right. So when the markets go crazy because Elon Musk tweeted something or whatever, right? Because anything can happen. COVID, things happen, in the capital markets. Hey, it could swing really, really quick. Now you're always advised not to panic when your, portfolio, your 401k or whatever is just going haywire. You leave it alone and let it work itself out. But what's unique about real estate and other what we call real assets, which would include, gold and silver, just real assets, you don't see crazy fluctuations there, right? And you're an appraiser, so you can speak to this. Yeah, values do go up and down, but they generally trail the more broad capital markets. And, it's usually not really, really fast responding. And so when it's all said and done, you have certain assets that are volatile, and then you have real estate where people generally feel more comfortable that they can drive by it. For one, prices aren't that volatile. For two, if it's income property like we're discussing, then your income, you're generally signing 12-month leases. That's not too crazy. Your expenses are pretty stable. Real estate really is a very boring P&L compared to, let's say, a small business that, manufactures widgets and they may lose a client.
Yep. And
just, everything changes. Where with real estate, now, once you have all your numbers, then it's pretty steady for the most part. Yep. And so people appreciate that. And obviously capital appreciation over the long term, given the good market. And we can touch on that, how to identify a good market. But given a good market, in addition to your income, you'll generally see good capital appreciation when it's time to sell.
And, honestly, that's the one thing that really attracted me about real estate, because it's so boring that you sleep really well at night.
Hell yeah, absolutely.
Right.
Very few situations where you're going to be like, oh, what am I going to do?
Yep.
You just don't have that. That's not something that happens. Even when something does happen, there's enough time for you to logically figure out what you need to do and implement a plan.
It's not perfect, but it is predictable. You can have a plan B for if your single tenant loses his or her job. You can have that in place. A lot of businesses you can't predict and project as well. Different things that could happen. You could have a business where you sell horse and buggies, and then this guy named Ford starts making all these vehicles. Now you're obsolete. Housing is never going to be obsolete.
Yeah, that is true. Very true. So you mentioned something. You mentioned, how do you identify a good market for real estate? How do you do that?
In a nutshell, you want to look for certain economic indicators. Let's go back to supply and demand. Not too dissimilar from the analogy I gave between the investor versus the homeowner who's looking to sell. With any market, you're going to have things that impact the local real estate market, right? And some of those things are going to be such as occupation type, but I guess I'm referring to more of employment growth. Do you have large employers? Is the city dependent on just a couple employers? Is it a diverse economy in that town? The reason that really impacts real estate, because it lends to whether or not population is going to decline or grow. So that's a really key. And I went the long way to get there, but a key economic indicator is population growth. If the city is losing people, well, what happens to the inventory, the real estate inventory? It's the case of Detroit.
Yeah.
So if we look at Detroit at its high, what was the population?
Inside the city, it was 2 million.
2 million. So at its bottom, if I'm not mistaken, it was around 600,000?
Yeah, 600. There's an argument. 600-700. Yeah.
It's the effect of, a person losing 100 pounds. The pants no longer fit. You have more pant than you have legs, and you have more property than you have home buyers. The prices have to go down.
Yeah.
Have to. And in some cases and in some cities, they go down to practically zero. And so to put that in reverse, that'll, okay, well, if it works that way, what if new industries and different employers come into a town, just anything to attract population growth? And it seems that it's going to be stable population growth. It's going to last. It's going to be long term. It's going to have the inverse effect. You're likely going to have lower inventory, more competition to purchase homes, which means usually, more competition to rent as well.
Okay. Again, like in Detroit, where you have, especially down in Midtown area, where when I was in college down there, down at Wayne State, it was, I'm not going to say it was a desert, but it was close.
Right.
it was close. But now you've got a lot of healthcare, you've got a lot of fintech with the rocket companies down there, and there are other companies that are spinoffs or associated with those. And just a lot of tech companies that have all populated that region have really exploded the regentrification of that area. Matter of fact, I was just talking to my dad. My dad, born and raised in the city of Detroit, and we were driving through Wayne State, and it was so funny because he's been here for I'm 50 years old. He's much older than that, right? So he remembers all of that stuff.
Yeah.
When it was really desolate. And we were driving down the road, and he was like, "Yeah." I was telling him about some buildings. I was like, "Yeah, that building's being renovated. Every house, every unit in that building now sells for $250,000 or above."
Wow.
And he's looking at me like, "You're crazy." I'm like, "Well, I may be crazy, but they're still selling for $250,000 or above."
Yep.
I mean, you say what you want, but it is what it is,
Right?
And just as few as, and it doesn't seem like it was that long ago. It was 10 years ago. 10 years ago, that was not the case. It just wasn't.
Yeah. Yep.
But that is what happens when you have population growth. And to your point, that population growth spurred on by job growth.
Yep. And it all ties together. So population growth, income, household income growth, employment growth, those sorts of things. When you see that, pay particular attention. And these are and that's a long-term investment strategy. If you're in and out, if it's a fix and flip, you generally don't have to look at that as much, just because your whole time is usually less than 12 months. But for long-term income property, regardless if it's multifamily, residential, commercial, like a mini mall, something like that, you want to pay particular attention to those economic indicators.
There you go. And then you also see a lot of other things. Going back to Midtown, you got a Whole Foods in Midtown Detroit. I mean, think about that.
Hey, that's a good, it's a good strategy, and it's not something like I have etched in stone or anything, but I thought about that just the other day. Whole Foods just came to Grand Rapids. I'm from Grand Rapids, Michigan. They just came to Grand Rapids maybe 6 months ago.
Really?
And yeah. So if you follow certain companies, I would say Whole Foods, maybe Chick-fil-A, I don't know, maybe Walmart in some instances. But if you follow some of these companies, these retailers or grocers, their real estate development team will do some work for you, because they're looking for some of the same stuff that we're looking for.
Yeah.
So you see, you're driving past the town that, you grew up, it, and you're like, they got a Whole Foods here? There may be some economic changes that you're unaware of. Income may be going up. Population may be going up. There's a reason. They're not going to put a Whole Foods in the wrong area, the wrong city.
Not at all. You were telling us about so much. You were telling us about investing, choosing markets successfully. And I know there were a couple other items you wanted to talk about too, specifically about doing some analyses, I think.
Yeah, you had asked the question last time, what's the difference between a real estate investment banker and, your typical lender? I'll walk through some of that. Okay, so my background is, I started, like I mentioned before, in I think 2003 as a conventional loan officer. Okay, I did that for about 10 years. And when I left, I joined Merrill Lynch as a wealth management advisor. I also owned a real estate company at the time. And so we did take advantage of some lower priced assets after the credit crisis and things. So I worked as a wealth management advisor, kind of sharpened my skills and just my knowledge base in terms of not just real estate, but capital markets in general, real estate and instruments and strategies in general. So, I did that and some M&A advisory work and some other things, business consulting. And when I came back to real estate, I feel like I had a more well-rounded understanding of investment in general. Sometimes you're in an industry or in a business where you can only have tunnel focus. You can only have tunnel vision. You really don't have anything to compare it to.
Yeah.
And so coming back, it wasn't even the goal. My goal, when I started the company, I was actually financing small businesses, doing a lot of like franchise financing. And I had a client who wanted to purchase a 2-unit. And just going through the process, the light bulb went off that I could provide a great deal of help to investors, real estate investors, who to scale in a couple different ways. They wanted to scale their business from, let's say, maybe 5 acquisitions or exits per year to 10 or 15. And that would be, from the operational standpoint, the financial standpoint, the business advisory standpoint. I felt that I could help. But then also if they wanted to transition from, residential 1 to 4 units up to, multifamily, larger apartments, or maybe syndications and raising equity from limited partners, if however far they wanted to go, I knew that I had the knowledge base and the skill to be able to help. And so that's the impetus of the company, but that's also the difference between myself and what you would usually expect from your lender, your hard money lender or your banker or whatever. That's the main difference. And so it's in the mission. Our mission is to help real estate investors build sustainable, profitable, and scalable businesses. That's the goal. I don't feel that I completely reinvented the wheel. I feel that a lot of what we do in some of the conversations, the level of conversation and some of the things that we pay particular attention to, it is done, but it's usually done at larger debt brokerages that are working on larger deals, larger institutional deals. So, a 250 unit apartment building, that's trading in New York for nearly $1 billion. They're going to call Berkadia. They're going to call, Meridian. And so who's there for the experienced, knowledgeable investor who may have a track record of, 25 exits and acquisitions in the last 3 years, but they really don't have anyone on their side helping out with the investment analysis and really structuring the lowest cost debt or equity financing and just helping them out with that. Because let's face it, their job really is to identify new projects and new investment opportunities.
Yeah.
Most real estate investors, I don't care how long they've been in it, they're not the most Excel savvy people. They're not, they understand a good deal. And a lot of them do rely on intuition and just a gut and just relationships. And that's fine. But we touched on it a little bit earlier. There comes a time, either because of the market cycle like we talked about, or because you realize that, hey, I'm never going to be able to scale the business to a certain level unless I create it in such a way where its operations and the processes are in place to do so. Else you lose your mind.
Yeah.
You can't always rely on back of the napkin. So that, in a nutshell, is what I think the difference is. So we're a direct lender, but also have a debt platform that includes everything from national banks to institutional private lenders. I think the reputation, because we do so much business, is hard money. We do a lot of bridge financing for 1 to 4 unit properties, but that's not it. That's not the only thing. So if you have
probably the introduction, that's at best, that's the introduction.
That's usually the introduction. And I didn't do this on purpose, but the order here under property type, single family, multifamily, new construction, in some ways, a lot of my clients kind of go in that order. So when we first start out, they may be buying single families, and then, I don't particularly like single family rentals. I always feel a little bit better with at least 2 units, just because anything can happen to the one unit, the one tenant, so I generally always say, well, let's look for at least 2, but oftentimes they'll, graduate, if you will, to multifamily, and then maybe even find some development projects and, some ground up construction and that sort of thing. So, and we can help with all of it. And so if it is a 100 unit apartment complex where, we're not using private money lenders, we may use agency financing at great rates with Greystone or some of the other agency lenders out in the marketplace.
Okay. So real quick, since we're talking about that, what I hear you saying is the market that financing growth really serves is they serve that niche between folks who've already made the decision to be active in the real estate investment arena. They're not trying to figure it out. They made that decision. They have some experience. Maybe they're not on the 1,000 unit project scale yet. Right. They've already started the journey. My question to you, though, is one of the things that you pointed out to me, and I thought it was pretty interesting, is even when you're switching between, say, 2 to 4 unit to maybe a 20 unit, and then from a 20 unit to 100 unit, there is a lot that goes on between those two. And even if you have experience with a bunch of 4 units, that doesn't necessarily mean that a debt lender, or anybody for that matter, is going to be interested in financing you for 100 units, right, even though you've got all that experience, because it's a different experience.
Yeah. The capital sources are different. Okay. The capital sources are different, and that's it. It pays off that we don't focus on just one capital source type, because that can be an advantage when you're trying to move from, one property type to another property type. It hurts people's feelings, but I tell people all the time, if you flipped 100 single family properties in the last 10 years, and you come to me and you say, hey, I found this 25 unit that I want to flip. I want to buy it, fix it up, same as I do, my 2 and 4 units. That capital provider will look at you as if you have 0 experience. In most cases, depending on the dollar amount. Now, let me just clarify, there are some capital providers who would lend to both. And that's rare that they'll go 25 units, though. They'll usually cap it at about 13. So you're usually working with a different capital source at 25 or 30 units. These are lenders who they wouldn't lend on single family residential stuff. Yeah. So to them, you have no experience. And so there is a path. There's a path to getting there, and we try to help map that out for our clients who do aspire, because everyone doesn't necessarily want to go into it, but a lot of them do. If you aspire to, go from residential to multifamily, then there's a blueprint that, we help lay out for you how to get there.
Yeah. I hear that all the time. And the reason I point that out is because oftentimes you hear some advice that is like, hey, you go and flip a house and then you can go and buy a 100-unit building. I'm not saying you can't.
It'll be difficult.
Exactly.
But it'll be very, very difficult.
Yes. So I'm sorry. I just needed to throw that in there because I just heard that actually.
Right.
Some of that.
And that's one of the things that you see on the slide here. Some of the different areas that we focus on that your typical loan broker wouldn't be able to help with. So, whether that's helping you transition to larger deals or, determining the appropriate capital structure. Let's say you progress, your process is in place, you've been an active investor for a while, you have a track record, we can demonstrate success. At that point, you may start to realize that, hey, I've built a machine as an active investor that would be attractive to passive investors. Where am I going with that? Well, at a certain point, you should be considering being a general partner and bringing on equity partners in a limited partner capacity, right? So, but again, it's like, think of a franchise model. You don't start off with a franchise. You prove your concept, you generate returns. But if you do well enough, if your systems are in place, if your processes are in place, you could make a really attractive pitch to potential franchisees that, hey, they should buy into this.
Yeah.
And it's, it's a loose comparison, but I just want people to kind of have that in mind early on, that it can pay off in ways that you're probably not thinking of today if you really develop a process, if you really understand the numbers, if you really keep a good record of your performance, because when it is time to let's go back to the 25 unit, when it is time to take that down and the asking price is 5 million, well, if you have that track record and you followed the blueprint, so we've gone from 4 units and maybe 6 and threw in a 10 and, a couple 12s, and we can make a case that, hey, you can handle 25, but the asking price is 5 million. Well, the capital stack on that may be all in, maybe 60-40, 60% debt, 40% equity. Of that 40% equity, that's a lot of cash.
Yeah.
It's a lot of cash.
Yeah.
And the way I always call them institutional, but your professional investors, institutional larger scale investors will go about that as a GP LP structure. And you go out and you raise money. Simply put, you raise equity from limited partners and give them a good return. I don't want to go too far into that, but I just want to kind of throw that out there so that some people who are listening wondering, well, what's this big advantage by having everything mapped out and from the beginning? Again, if the goal is to make a lot of money in this business in a way that does not kill you, in a way that does not burn you out, and this would go for any entrepreneur, really, have your processes in place, have your team in place, and know what the ultimate goal is. And if the ultimate goal is, large scale, we want to talk to you. We want to help you get there. We want to be your partner.
That's what I wanted to hear from you. That's the difference. And that's the difference between dealing with somebody who's going to do a transaction, a one-off transaction, i.e., I need money for this house that I'm going to flip. And then once I flip it, then I'll never hear from this person again.
It's funny you say that. I literally go out of my way to dissuade one-off transactions. And I'll say it. I'll say, look, what was your performance last year? What's your goal this year? Even if they're new, how many properties would you like to purchase? I want to get a decent idea of where they want to go with this business, because the one-off transaction, it's not efficient. It's not efficient for us and what we're offering. I'd rather you just go to a lender. What we provide wouldn't be as much help. So we charge upfront onboarding fee, and then, it's only $550, but we set up your client portal and everything is set up for us to do volume, for us to do multiple deals. And if that's not really the goal, I don't think we would be the best fit.
I appreciate that. So again, if you are somebody if you're testing this out, the idea that you want to be an investor and you're testing that idea, this is not the place to test. We had to make some decisions previous to having discussions with Dante. And that's realistic. I mean, that's realistic because at some point, and that's one of the interesting things about being an investor, right? You jump in and you do whatever. And I personally think, let me back off a little bit. As much as I love YouTube, there's a lot of steps missing oftentimes that people don't talk about. Just because you watch a video doesn't mean that you know how to translate that stuff. Now, oftentimes that video will give you a lot of hints. Point you in the right direction, but you got to get off your butt and get to it. You got to commit to making it work for you. And, sometimes that doesn't happen, which leads to
unrealistic expectations. And
there you go.
Yeah.
There you go.
One thing I want to throw out there too, though, because I don't want to discourage someone who is serious about this business, but they haven't stepped out and made their first investment. I didn't start the company off with them in mind. But over the years, I have a good friend of mine. He's really serious. And we have been able to help them. And I can help them. The only reason why that's not my preferred entry point into the relationship is because they generally don't have as much value on what's going on because they haven't dealt with anything else. They don't know what it's like to work with a loan officer or loan broker, fill out an application and wait. That's it. They say, hey, send me this document, that document. We'll get back to you with a term sheet. Yep, here's the term sheet. We'll order the appraisal. That's it. Their interest is their investors who provided the capital, right? And so that's the dynamic switch that I think a more experienced investor just appreciates having someone on their team. And so the way I describe it is we are business partners and I'm the finance department and you're the project manager. You're out there finding deals. I'm handling, everything, related to finance, just, double checking everything to make sure that the investment merits are in place, teaching you how to underwrite deals better so you don't, need me to manually do it every single time. And we're just having these discussions and we're talking things through. So one of my clients refers to me as his real estate attorney. And listen, I hope, no one confuses me for that. That's not what I am. But he was just saying the type of relationship that we have. So, he can call about this or he can call about that. Just over 1,000 transactions, you learn a lot of stuff. And so I've been lately, I'd say the last 3 months, I've been really more encouraged, almost felt a sense of responsibility to work with newer investors. And it's because of we're in a guru industry, right? We're in a guru industry where people drop $25,000 for courses. And there are a lot of big platforms and names of experts who don't give really good advice. And I see it all the time. I see it all the time. It's kind of sad. So if you're going to drop $25,000 on a course or something like that, I'll take you on for $549 and let's get some deals done and really set you up the right way.
Absolutely. Then you can use that money to, buy a property.
Equity to put aside. See, right. And that actually happened. That's a real client situation, $25,000. And after the course, he had no idea what NOI stood for. He'd never heard the term net operating income after spending $25,000.
And just so if anybody's out there watching, net operating income is like basic. It's basic for financial analysis. And as an investor, and that's what if you're watching this, if you watch this far, that's what you are. As an investor, it's all about the numbers and the net operating income. That's really what it comes down to.
It's critical. And in fact, here to that point, I'll kind of demonstrate our approach to the numbers. Okay. That's the tribe, right? So if you don't care about the numbers at all, we probably won't get along well. If you don't understand the numbers or you don't understand financial modeling and stuff like that, that doesn't matter. That's fine. I'll say again to the question, investment banking, and I kind of made that up, real estate investment banking at this level. But that versus your hard money lender who's going to finance a bridge loan I already explained it. Application, 2 pages, documents, order appraisal. That's that. They'll let you know if it doesn't work for them. For us, it's a little different. So here's an actual deal that I closed last week. When we came in, we wanted to make sure it checked a lot of boxes. Okay, so we wanted to make sure that the return metrics were on target, right? Anything lower than a 15% IRR, that's a quick pass. Anything over, I'd say
IRR
20,
being
we'll look
internal
at
rate of return.
internal rate of return. Okay. Once it hits 20, we'll look a little closer. Ideally, and it just depends on the market, 30 and up, that's a good situation. We usually want to jump on that. Same thing with you'll see EMX, which is equity multiple. It's basically how many times can you turn $1 over? If you can turn it over twice, that's great. Anything over that, that's really what we want. And then levered and unlevered just means using debt versus what your returns would be if you used all cash. So that comes up a lot, and that's always easy to show. If I have a client that's saying, well, would it be better if I just went ahead and just purchased it cash? And I say, well, you could get a 14.5% return, or you could get a 50% return. But we want to use debt intelligently. Debt is dangerous, but it's actually cheaper than equity. By definition, it's leverage. So it allows you to increase your returns. This is why.
So what would the difference be between debt and equity for somebody who's, they're committed, but they're still learning the terms?
Okay. All right. So I'll give it to you in a couple different definitions. So debt has a fixed repayment of some sort, and
your mortgage,
generally a term of some sort, right? So it's a promise to pay, I'll call it. Okay. If I give you $50,000 to purchase and sell a property, and I want you to return $60,000 by, let's say, 10 months, that's debt. How do you know that it's debt? It's debt because I didn't ride the risk wave with whether or not you were profitable on your project. My interest was $10,000. It was clear cut, and you owe me the money whether the home burns down and you don't sell it or whatever. You still owe me $60,000. That's debt. Now, if I wanted to invest $50,000 into your project equity, there wouldn't be a repayment date. In that scenario, I'm going to get a certain percentage of the profits or losses. And so let's say your projected net profit was 50,000, and I gave you the 50 of my cash for 50% of the net, then I would make 25,000, but I took more risk. And so you see how debt cost you 10,000, equity cost you 25 for the same 50,000. The 25 required more risk on my behalf, because if it was a loss, I would absorb the loss with you. If you only made a net profit of 10,000, then my take home would only been 5.
Yeah.
So I rolled the risk wave with you, which is why I get a loftier return. The benefit to you is that, hey, if it doesn't work out, there's no repayment date. Debt doesn't matter. You owe them. So they take a little less risk. But their return is, I hate to use the word guaranteed, but it's fixed. It's a return that is not reliant on the success of whatever your endeavor or venture is.
Mm-hmm. Okay. Kind of like a mortgage, like a traditional home mortgage.
That's exactly what a traditional home mortgage is. That would be debt. Your equity would be the cash that you put into it. So your down payment.
Okay. And in the scenario you just presented, maybe you got your down payment from your uncle, and he's going to roll with you and for 50% of the net profit.
Yeah, we could use it for an owner occupancy scenario because, most people own a home and it's easy to understand, so Uncle John gives you $25,000 for your down payment. And he just kind of figures that, hey, you'll probably stay in the home for 5 or 10 years, and he's willing to wait. His only catch is when you sell the home, whatever, the difference is between what you sell it for and what you owe the bank, I want to take half. And you say, okay. And so you purchased it for 100, you sold it in 10 years for 200, and Uncle John just turned his $25,000 investment to 50,000. It took 10 years. He probably could have had a better investment, but he feels good about it.
Okay, there you go. There you go. You feel
So,
good about it, and hopefully you're still his favorite nephew.
right. But hey, it might not be a bad deal.
Exactly.
Might be a bad deal.
Exactly.
So here's our development model. Basically, I'll explain the scenario. So my client is purchasing a home in need of renovation, and the goal is to rehab the home, rent the home, and turn around. We're going to refinance it and hold it long term. And so what we want to do early on, one of the first things that we do after looking at the market and the property itself, when it comes to the finances, and I find it critical that I understand the full story so that I can structure the debt appropriately on the front end. And I'll kind of walk you through it. Again, this is something that your traditional lender isn't really going to do. Okay, so you have two transactions that we want to understand. The first one is he's going to buy the property, and we're going to have a purchase price, which is 110. We're going to have a rehab budget, which is 72,000. And we're going to try to get him as much leverage as we can so that this cash, the equity needed into the deal is minimal. All right. So we were able to do 100% of the construction budget in a construction holdback. What that means is, as he's going along with the project, he'll have inspections and draws. So he'll spend $5,000, have an inspector come out, and he'll give the thumbs up, and he'll receive the $5,000, back in about 3 days. That keeps the cash flow going and allows you to not have so much cash tied up. So by doing it that way, we can also work on other projects, which we're working on, 3 other projects with this particular client here. And so that's the top part in green is the bridge debt structure. Okay.
Bridge debt meaning the area between when he purchased the property initially and when he gets his ultimate end financing.
Right. Exactly. So bridge financing is usually higher cost, shorter term financing. It's going to be the same type of product for building a home from the ground up. Any developer, they're going to use a construction loan, which is a bridge loan. So bridge loans aren't always construction loans, but a construction loan would always be a bridge loan.
Got it.
So what we do is we model that part out. There's a couple different ways that we can do the budget. I have a simple budget method where, we're just moving quick and we say, okay, it's going to be 50,000 and then we'll get a return. Or you can actually tie in to a detailed budget. It'll flow to the underwriting tab, which takes a little bit more time, but it's useful because you can see how the interest will impact your debt service payments, right? Because of your schedule, weekly. And so that's really where your payments are derived from, right? And so bottle all that out too. You can get as deep as you want with this. And I'll just explain. So here's your full loan interest payment with this deal. But since the interest is only charged on the drawn balance, you really can't, it varies. You can't say it. You'd have to, you can't know that up front unless you model out which weeks you're going to draw down. So that's what that's about.
That's an important difference because I've seen loans where the interest is actually based on the approved loan amount. So for instance, in this particular case,
sometimes it is. And in fact, it was on this deal, I believe, because the loan amount was under 120. No, it wasn't on this deal. The loan amount was over 120, so it wasn't. But when it's under 120, most lenders, most capital providers, they want to have what's called full boat, meaning they want interest on the full loan amount, not just the advance in the construction budget as you go along. The reason is easy to understand is that they're going to make a lot less money because it's a tiny loan, right? So you have full boat versus interest paid on drawn balance. Those are usually your two options.
Got it.
So we want to include the project timing in the model, how long we're project the construction process to take, how long the underwriting for the refinance is going to take. And we take all that stuff into account. In this one here, we were projecting that the project start timing was November 1st and refi would be targeted for, January 24th. So that's the first transaction. So we're high-fiving, he's closed, he's starting a project. Well, before we go there though, we want to take a peek into the future. And I'll explain why. We want to model out the planned refinance. Let's just model that out on the front end so everything is where we need it to be. Okay, so in order for us to figure out if this is going to be a good deal, even on the bridge loan, your lender, if you're saying, hey, I'm getting a fix and flip loan, they're not even going to ask you for your rents. But as an investor, you should probably know what you're going to rent it for, so we can determine whether or not this is a good play. And so we can go to Rent-A-Meter here. I think it's really accurate in a lot of markets. But yeah, if you want to have a data-based market comp, instead of saying, hey, I think, the neighbor rented theirs for, I would use Rent-A-Meter. I think I have a premium account. If I do, I can't be paying more than $15 a month. So just throwing that out there, but pay it. It's quick. It takes me 2 minutes. Yeah, it takes me 2 minutes to pull it up. Right.
They just ran a special for the premium account for $70 a year.
There you go.
I'm certain they're going to do it again before the end of the year.
Right. It'll help me catch a red flag sometimes too, because, my clients, they have access to the model, and once they get used to it, they can put the information in. And, sometimes people are moving fast, or maybe we're doing it over the phone and I'm running the numbers for them. And it could be, oh yeah, I think I can rent it for $2,500 a month each unit. And I go to Rent-A-Meter and it's saying $1,600. I'm saying, hey, FYI, you might be a little optimistic there, right? And so it helps me build out stress tests on the numbers, right? So we plug that in, and then we, start structuring the perm loan. Well, I know, and my clients wouldn't know this, your favorite expert on YouTube wouldn't know this, I know where leverage ratios are for certain types of properties, given your FICO score, given your experience, and all the different variables. And so I can pretty much give you within 5%, of what your refinance leverage ratio ought to be. Cash out refi for this particular client is going to be about 70%. When I ran this, rates are high. When I ran this, rates would be, 7.7. And what we want to see here is full AM, so no interest only period. We want to make sure that this debt service is over 1.2. Debt service coverage ratio is very, very, very important to lenders. Let me explain why. Okay, now we're at 1.2. You see it?
What is the debt service coverage ratio? I'm pretty sure I understand what it is, but
so here's 1.2 debt service coverage ratio. What that means is after revenues and expenses, which is where we come up with our NOI,
net operating income.
Okay. After that, we have debt service. Debt service is your mortgage payment. So we're going to make $19,400 before paying our debt, and our debt payments total 16, which means, after we account for just some arbitrary reserves we want to set aside, we got some cash left. Okay. A lender feels that they want this number a certain amount higher than this number. Does that make sense?
Yes.
Okay.
They want to make sure that you have money to pay the mortgage.
Exactly. So if I bump up expenses, if you still have enough money on paper to pay your mortgage, but look at the debt service coverage ratio, it just turned red because it's under 1.2, right? So,
and that's important because on paper, we think the water bill or the utility bill is going to be $1,000. Yep. But that doesn't account for the fact that your tenant or tenants left the water running for the last, for 12 weeks in a row and never told you.
Never told you. You got, anything going on that's just unexpected. Your lender wants to see this. And so we can model that out on the front end. It only makes sense to. I just had a conversation yesterday where the bridge loan structure, that was fine, but once we came, to the perm loan, it wasn't right. And so what we're doing here is we're just taking 70% of what we thought the after repair value would be when, because we need the after repair value when we do the bridge loan. Mm-hmm. So that's really important. When we're having discussions, I'm asking three main questions. What's the purchase price? What's the rehab amount? What's the ARV, the after repair value? Okay, so what we do down here to help kind of model out the refinances, we'll use this leverage ratio. This is the percentage of the value that the lender is likely to give you. And that's where we come up with the 189. And so I may have to play around with this loan amount based on just not over leveraging the project, not even necessarily what you qualify for. And see, this is where it steps outside of lending guidelines and, the loan process, so to speak. We may want to set your expectations appropriately. We may want to not do the 70%, which you qualify for. We may want to drop it down to 65 just to be a little bit more conservative. There may be reasons why, hey, you want just a little bit more cushion after your debt service. Well, what does that impact? Well, it impacts your expected cash out amount. So, and these are things that we can just think through the whole process as we're putting it together. And so this is what we do. We do this in addition to a bunch of other stuff, but I think this illustrates the importance on the economic merits of the transaction. We want that to be solid. We don't want our guys, we don't want our clients in bad situations. We want to put you in the best situation possible. We want to do a lot of deals. We want you to grow. We want to help you build your team. And we want you to have a great reputation in your market. We want you to be known as the investor that has it all together and someone who can execute. That's our part of the team. And this is one of the ways that we try to help do that.
There we go. And one of the things that Dante touched on, he talked about reputation. Reputation is extremely important because a bad reputation will definitely precede you, but a good reputation will make you tons and tons of money. And that's just the way it is. I mean, a day doesn't go by where because we have a good reputation doing whatever it is that we do, people bring other additional opportunities to us, right? Those things only happen because we have a good reputation, and you got to protect your reputation however you can. And one of the things that Dante is very, very good at is making sure that you don't overstep, put your foot someplace where it doesn't belong, and ultimately ruin your reputation.
It's key, it's vital. And we touched on it earlier. That's what I was alluding to when I said, if the goal is kind of big, and maybe you weren't thinking about it, maybe this interview is helping you think a little larger. When I said, you have your track record, you have your process, you're building the machine. Mm-hmm. It could, if you want it to, it could pay off in the form of passive investors, passive accredited investors who see that you've built a money printing machine and they want to invest alongside you. And that's reputation. Reputation is valuable.
Reputation is very valuable. All right. So with that, Dante, I've taken up a lot of your time, and I promised you we will be about an hour. Now we're a little bit over, so I'm going to keep up with my reputation. And I'm going to give you a few minutes to have some ending comments.
Yeah. I told you, what I do is it's a passion thing. I don't feel like I work much. I'm busy, but it's not really work. My mother is a real estate broker. She's been a real estate broker for, I think, 35 years. My brother is the one who talked me into the business. He was a mortgage broker during that time, and he's got me by 10 years. So, he was pretty successful in 03, the 03 that I had mentioned. He talked me into, getting on the number side. He's a general contractor now. And my younger brother, he's newly licensed. This is, I think, deeper than a career for me. And so when we're talking about it, You may feel like you're bothering me with questions. If I talk to my brother, we'll be talking about deals. It's something that I enjoy. It's something that I don't think I'll ever not have my hand on real estate in some way, shape, or form. So if something in this interview resonates with you, man, feel free to reach out to me. I'm sure, Jimmy, you'll have all the contact information.
Absolutely.
Website is www.financinggrowth.org. You can also email me direct at Dante@financinggrowth.org, DANTE. And if you got questions or you're thinking about figuring out how you want to scale or build your business, or even if like we had discussed earlier, you haven't done a deal, but you don't want to pay a pricey lesson, we could talk about it.
Yeah.
So I hope it was helpful.
Absolutely. And again, Dante, I want to thank you on behalf of myself, because every time I talk to you, I learn something. I didn't know that it was literally a family affair with you. I didn't know that.
Yeah, man. I was putting up for sale signs when I was 7 years old.
See, that's what I'm talking about.
Yeah.
See, I thought that I was the only one in and out of houses.
Oh man, yeah. No, I learned to think that a dilapidated property was a potential good deal when I was a little kid, man.
That's what I'm talking about. That's how I grew up.
Okay. I didn't know that.
That's how I grew up. Yep.
Yeah.
Between my dad and my uncles, I was in and out of houses. I mean, that's just what we did. That's just what we did.
Yep.
And it got to the point where even when it was time for me to go to college, and they hit me with what do you want to do? And I was like, well, I want to create jobs for other people. That's what I wanted to do. That was my goal. Create opportunity and jobs for other people. And the other part I also learned about that too, and this is I learned that being the owning real estate specifically, gave you the opportunity to do some things that if you didn't own the real estate, you just couldn't do, or that people around you couldn't do. So, I mean, that's how I got into it. That's what developed my love, because I saw that at a very early age, and I saw it consistent, whether it be on the contractor side, whether it be on the ownership side. I saw a lot of it, and I'm very thankful for that, because it's colored my thinking from that moment on. Tell my kids that all the time. They probably get tired of it, but they'll figure it out as they get older. They'll come back.
Keep sharing the wealth of knowledge, man. I appreciate what you're doing, and with the podcast and everything, man, and giving me an opportunity to share some of the things that I've learned over the years. And there are people in this business. I spoke earlier about the gurus who probably don't have as much transaction experience as they claim to, but it's a beautiful community, man. I almost find it a little discrediting referring to the people that I work with as clients, and I mean that. I even in my material I call them client partners, is because that's really the relationship, and you just meet so many great people, appraisers, property managers, and just I work with my friends all day.
You do. Hey, we're here in Michigan, but you work around the country, don't you?
I do. Yep. I finance deals anywhere. I'm looking at doing some stuff in Miami. I'm in Chicago now. So yeah, anywhere.
Okay. Good deal. Well, Dante Shackleford of Financing Growth, thank you. You have dropped some amazing pearls for us here, and I appreciate that. And I'm sure there's going to be at least 10 to 15 folk to be giving you a call within the next couple of weeks, at least.
Hey, okay. Bring them on. I appreciate it.
All right. Dante, thank you again, man.